David, I actually want to highlight something Diana just said, which is this isn't all about mortgage rates because there's tons of cash buyers out there, and yet the housing market is still slowing. So what do you think is going on here?
Well, we don't cover the builders. So, our coverage is more on the building materials. So, my focus tends to be a little more on the repair and remodel segment. And there, the market's in very good shape right now. I mean, people are working, consumers have cash, real estate prices are going up. The fundamental story there continues to be very, very good. From a new mortgage origination standpoint, again, having said I don't cover the space, but it seems like just from history, the psychology in the market has to adjust around the rate change, and then we're right back to it.
But so, I take your point, David. I mean, if I had a blindfold and didn't know how these stocks had performed, your stocks I'm talking about, sort of home improvement space, whatever you want to call it, I guess I wouldn't have a blindfold as I was walking my neighborhood. I mean, it is huge demand out there, huge demand. Yeah. I don't understand. Was the demand just stronger the last couple of years and now it's moderating? It feels like we're in the middle of a 5 to 10 year tremendous boom in demand for these services. So what explains the stock's underperformance, or am I just not understanding, what's really going on here?
Sure. Well, there's obviously been a lot of negative investor sentiment around the upcoming first quarter earnings release, and probably for good reason. You've had some slowing data points in U.S. residential housing. There's growing recessionary concerns. There was a fourth quarter acceleration in cost inflation that left a lot of these companies behind in 1Q until they can get some 2Q traction around pricing pass-through. First quarter volumes are the most difficult comps of the year. And of course, supply channel is not improving. So, that's a lot. And when you stack all that up, the first quarter margins are probably going to look a lot like fourth quarter. And so they've been popular shorts. Our feeling is that, the second quarter is going to be better, and even better still in the second half of the year. Residential repair and remodel spending continues to be good. We just talked about that. Price increases that are necessary to offset the cost inflation are in the market today. The problem, of course, is that all these companies had extended backlogs, and there was no price increase on the backlog, and that had to work through in 1Q. So you get to the beginning of 2Q, you start to get the benefit of that pricing, and some of the incremental margins in these companies could be improving by 200, 300, 400 basis points sequentially. So very strong comps coming up there. And then finally, I would just say a lot of these management teams have been very conservative with their 2022 guidance. They knew what they were facing coming in. And so you start to look at the possibility of getting any kind of volume relief or even commodity cost relief in the second half of the year. And it may come as a surprise to you, but we could be looking at beat and raise situations on some of these names in the second half of the year. So for some of the names in our coverage, we see an opportunity on the long side, along with any weakness that may accompany the first quarter earnings releases.
Hey, Dave, I want to circle back to something you just talked about, pricing power. You're talking to somebody that's actually looking for a new dishwasher and a new garbage disposal for their kitchen. I'm shopping around. The prices are really high right now. So I have to ask you, how much is inflation hitting these stocks? And when you talk about a strong remodel market, what percentage of their sales generally come from remodeling?
Well, by and large, they're anywhere from 2/3 to 3/4 of their revenues are generated from remodel markets. Really? And then from an inflation standpoint, the big concern is just going to be elasticity of demand. And, to what extent does the consumer at some point recoil here? On things like appliances, which is, the example you gave, because it's such an infrequent purchase, people are purchasing every 8, 10 years. There really isn't as much of a reference point as, say, there would be for, any kind of unhappiness around what you paid for a gallon of gasoline this week. So I think without that sort of more frequent purchase context, it's less likely to be a factor.
Shepard Smith here. Thanks for watching CNBC on YouTube.